everybody, and thank you so much for joining us today. My name is Sam. I'm in client services here at the Retirement Group, and I'm going to be moderating this webinar. You'll see me throw some useful links into the chat. They'll direct you to our extensive ExxonMobil retirement guide, as well as a link to book an appointment with an advisor after this webinar. Today, Wesley Boudreau is our speaker, and he's going to be speaking to ExxonMobil employees about the newest interest rates that have just come out and whether or not this could potentially impact your ExxonMobil lump sum. But before I bring Wesley on, I'd just like to remind you that although the retirement group has extensive knowledge of ExxonMobil's retirement plan, and although we work very closely with both active and retired members of ExxonMobil, we are not affiliated nor endorsed by ExxonMobil. We are a completely independent group of financial advisors. And I think that was all I had to say. I'm going to introduce Wesley Boudreau. Wesley.
All right, thanks. Appreciate that introduction, Sam. Like she said, we're going to talk about the interest rates and how they've been changed for second quarter to third quarter for 2023. Before, just a quick reminder, those of you who do not know who the retirement group is, again, we are an independent financial advisory firm that focuses on working with corporate employees and help them transition into retirement. The retirement group's been around for a little bit over 30 years, and for a large chunk of that, we've been working with ExxonMobil employees. So we've got a pretty deep understanding of your benefits, not just the pension plan we'll talk about today, but also the 401k, healthcare, retiree, medical, life insurance, all those different options. So should you have any questions on this, just feel free to reach out, give us a call. We'll be happy to dig into that. I know we do have offices throughout the country, so rest assured if you need to sit down with somebody face-to-face, we can probably still accommodate that. Obviously, this day and age, it's very easy to have a lot of meetings via web meetings, phone call, email, whatever your preferred communication method is, just let us know. And at the end of the day, if you take us up on anything, especially if we're going to talk about these interest rates and how they change from quarter to quarter, is to run a cash flow analysis. This is actually a detailed financial plan specific to the ExxonMobil benefits plan, so we can let you understand your 401k, your pension, your claiming strategies, get into NUA, all those different options that are really important as you transition from an employee to a retiree. So whether you're looking at retiring in 10 days or 10 years, just give us a call, let us know. We can run that review or update it if it's been over a year, because we've seen a lot of changes, obviously, in interest rates, as well as changes in the market over the last year or so. But let's kind of get into the pension. That's what we're going to talk about today, give you the interest rate update. But a quick reminder for those of you who do not recall, ExxonMobil pension plan, which is a great pension plan, one of the companies that still has one. It is a classic defined benefit plan, in which case there's a formula that's used to calculate out your benefit. So they look at your years of service, your final average pay, and a 1.6% multiplier in a Social Security offset to calculate out what your single life annuity is going to be for the rest of your life. Now, from there, you have options if you want to do a joint survivor to cover your spouse or significant other, whether you want to do a period certain, so you make sure your beneficiaries are paid out for a period of time, or if you want to do a lump sum. And that's where the interest rates come into play, where we have to take a look at what the current interest rates are for the quarter. ExxonMobil updates them quarterly, and run a net present value calculation to figure that out. So what they do is they take a look at that single life annuity, then they go in there and look at the segment rates or the GAT rate if you're a grandfather employee, and I'll talk about that in a moment, and run that calculation looking at your at what your single life annuity payment is going to be. How old are you? So they look at longevity tables to figure out how many more years or months they have to pay you, and they use that for a net present value calculation to find out what they're going to have to give you as a lump sum for you to essentially go out there and try and recreate that same annuity stream yourself. So when interest rates are lower, they have to give you more money to try and recreate that annuity stream. When interest rates are higher, they don't have to give you quite as much. Think about it like a mortgage. When interest rates are low, you can afford a bigger house, so kind of a bigger lump sum, if you would. When interest rates are higher, like we're seeing right now, it's going to take a little bit more to buy that house. So what happens is we look at the seesaw pattern at the top. Just keep in the back of your mind, when interest rates go down, which we saw happen during the pandemic, you're going to see lump sums go up. The opposite's true when we see interest rates come up, which we've been seeing the last year or so. We're going to see lump sums come down. Now, unfortunately, probably the best day to retire if you're strictly just focusing on your lump sum calculation would have been in the last, about a little bit over a year ago, because we were in the lowest interest rate environment we've ever seen, thanks to the pandemic, where the government drove those rates down, probably down too low. And now we've seen the flip side where that pendulum swung, and we're driving the rates up pretty quickly, and they've moved up very sharply in 2022. And so that's actually driven those lump sums back down. So hopefully we'll see that pendulum kind of swing back and forth and get to a kind of a happy medium, more of a long-term approach right now. But the way ExxonMobil does it is a little bit different than other companies. They do it on a quarterly basis for that interest rate schedule. You're either grandfather or not. A grandfather employee is an employee that's been around longer, that is at least 65 years old and has 25 years of work as of the end of last year, 2022. That's the GAT rate, which is going to be focused on the 30-year Treasury times 95%. So it's going to be a lower interest rate, which in turn is usually a higher lump sum. And then for those of you who are not, which most of you probably, it's going to be the Pension Protection Act segment rates. So those are going to be three different segments. They look at the first, second, and third segment. The first segment covers the first 5 years of retirement. The second segment covers years 6 through 20. And the third segment for years 21 and beyond. So for most of us, that second segment is going to have the highest weighting because it covers about 15 years of retirement in there. And what they do is they look at the average of the previous third and fourth month in order to figure out what you're going to get for that quarter. So we take a look at this in white. We've got the rates for March and February. The average of those are going to give us the third quarter interest rates, which you'll see is the first one in the blue line. Now, if you take a look at these, that third quarter versus the second quarter, you can see not too much of a change. Let me kind of zoom in here so it's a little bit easier to see first. But if we look at this, the third quarter is going to be 5% for the first segment, 5.16 for the second segment, and 5.06 for the third. Right now in the second quarter, if you were to pull the trigger, it's a little bit lower for the first segment, but higher for the second and third segment. Not too much higher though, because we are seeing the fact that those interest rates have leveled out. If we look lower on this chart, you'll see how low they used to be, but unfortunately that's hindsight's 2020. We can't do anything about that right now. What we did see was a move for interest rates moving lower, but unfortunately that's kind of been reversed a little bit here in the short term, hopefully. We saw the segment rates kind of peak in October. They came down November, December, and January, but then started to come back up in February and March. They didn't come up enough to offset what we had for November, December. So again, if you're looking at retiring right now and you're questioning if I'm taking the lump sum, do I pull the trigger for second quarter or third quarter? Actually, third quarter is going to come out a little bit better for you. It's not going to be a huge change, but it will be a little bit better. And then beyond that, it may make sense to actually wait a little bit longer and see what's going to happen for fourth quarter. If those interest rates come down anymore, that could again drive up your lump sum a bit. The quick rule of thumb is a 1% change in interest rates equals anywhere from an 8 to a 12% change in your lump sum calculation, depending upon your age. So just keep in mind, 1% equals 10%. So if we look at that 5.38 drop into 5.16 for second quarter to the third quarter, in the second segment, that's roughly about 20 basis points. So probably about a 2% jump, give or take, on your lump sum from second quarter to third quarter. The other thing to think about here is also age penalties, depending upon how old you are. If you're retiring before 60, it may make sense to defer out of some of those age penalties as well. And we go through all of that when we talk about that cash flow analysis and get into the planning phases with you. So the best way to kind of tie all this together and find out, are you on the right path to retire? And if we need to watch quarter by quarter to pull the trigger on the commencement, again, that's the commencement, because you retire first, then you can defer your benefits if you want to. But the best way to do that is to go through that cash flow analysis that we mentioned before. Right now, about 3/4 of Americans over 50 don't have a written plan. If you can spend about 5 to 10, maybe 15 minutes with us gathering some data, or we can email out what that data, what the questions are we need to get answered. Give us about a week, we'll put together a detailed cash flow analysis specific to the ExxonMobil plans and let you know where you stand and help you determine the best day to retire so you can maximize your benefits. So again, that was a quick update. If you have any questions, always reach out to us at 800-900-5867. You can also email us at info@theretirementgroup.com. I'll leave this screen up here for a little bit. I think Sam's going to come back with some questions to answer, but there's a couple QR codes on here. Go ahead and use your phone if you want to schedule a meeting with myself or one of the other ExxonMobil focused advisors, or if you want to follow us on LinkedIn so you get updated information specific to the ExxonMobil plans. All right, Sam, do we have any, I think some of the questions you said that came through the last week?
Yes, we've had a few questions. These are the most popular, so we're just going to go through in order. The first one, Wesley, is how does the Social Security offset impact my ExxonMobil pension benefits, and how can I optimize my overall retirement income? Okay, all right. So 2 questions there. I think I mentioned briefly when I kind of gave that formula. But what happens is essentially while we're working, if you're an employee, your employer pays half of your Social Security or your FICA taxes. Mm-hmm. And so what happens is they're essentially going in there, they're going to kind of claw that back. So they run that calculation. They look at your final average pay, your years of service,
a multiplier, and then they subtract out a Social Security offset. So what happens is when you go in there, the assumption is they look at what your income is at ExxonMobil, look at based upon your age, they do a simple Social Security calculation to determine what that Social Security offset is going to be. I'd say 9 times out of 10, everything's pretty accurate. You just want to keep that there. Maybe really 95% of the time is probably accurate, but a couple times, if you're somebody that maybe hasn't worked at ExxonMobil your entire career, and especially if you worked in the public sector before, maybe you're a teacher or administrator or something like that, and you didn't have full contributions to Social Security, it may be beneficial to have us run your Social Security estimate and see how that matches up to the Social Security offset that ExxonMobil calculates in your estimate. And if it comes out that your Social Security is lower, then we can actually submit that to ExxonMobil, and you'll get a bump in either your annuity or your lump sum. We've seen these bumps, from anywhere from, $50 to a couple $100 a month up to, $30,000, $40,000 in a lump sum. So it is important to understand that. So if you think you have something like that, give us a call to go through it, because you don't want to submit it without going through us, because you make a mistake the other side, they could actually reduce your pension a little bit as well if you're not aware of that. And I think the second question was how to optimize. Really, it goes back to that cash flow analysis I mentioned before. There's too many things to kind of look at as far as how to optimize your retirement. But again, it's going to come into, for ExxonMobil employees, the best way to pull the trigger on that pension, whether it's the annuity or the lump sum or a combination. When do you actually pull the trigger? Do you commence your benefits at retirement? Do you defer them? How do you treat your 401k? Do you do a rollover? Do you look at NUA? We go through all those different options in that cash flow analysis, and that's the best way to really dig into optimization, because everybody's unique.
All righty. Thank you. The second question we've gotten: how will the Federal Reserve's future monetary policy actions impact my lump sum value? Okay.
So we mentioned, the segment rates are going to be used to calculate out the lump sum. Those are the PPA segment rates, so the Pension Protection Act segment rates. Those are a little bit more tied towards corporate bond rates than what they are the Fed rates, but that doesn't mean that they're not going to move in unison usually. So if we see the Fed continue to raise interest rates, then obviously that's going to in turn kind of raise the rates across the board on all fixed instruments, which would of course include corporate bonds. So, we'll see if interest rates keep going up. I think hopefully we're here to the kind of the close to the end, where we'll hopefully stabilize and maybe come back down, get more to a long-term average. But if they keep going up, then we could also, yes, keep seeing the interest rates for the pension calculation, lump sum calculation go up as well, which could drive down that lump sum even further. But if the opposite happens, if we kind of stabilize here and start to go down in the coming years, then you'll start to see those interest rates go back to the norm. And you'll start to see that lump sum come up a little bit as well. All righty, thank you.
How do the grandfathered and non-grandfathered pension calculation methods and interest rates differ for ExxonMobil employees?
Okay, yeah, I apologize. I think I maybe skimmed over that on the chart, but so again, it's going to depend. You're either grandfather or you're not. So what the way to tell that is when you run your pension estimate through the ExxonMobil tool, it'll show you. But the other simple way is you have to be at least 65 years and have 25 years of service by the end of last year. So by December 31st, 2022, then your grandfather. And it's a good thing to be grandfather, because you're going to ultimately have a lower interest rate, which in turn is going to mean a higher lump sum. So instead of the PPA segment rates, they look at the GAP rate, which is looking at the average of the 30-year treasury times 95%. And but they round it to the nearest quarter point. So going back to that chart, I think it's a 3.25 right now. It was I think 3.5, excuse me, 3.75. Excuse me, I think it's 3.5% right now. It was 3.75 for second quarter. So again, we looked at that second segment for third quarter for the PPA segment rates was right around 5%. So that's about a 1.5% difference. So that means somebody who's grandfather is probably going to get about a 15% better lump sum. But again, there's nothing you can go in there and change that. That's either your grandfathered or not, based upon how old you are and when you were hired at ExxonMobil.
All righty, thank you. One last one. This is a little longer one, but how can I ensure that my spouse or dependents are protected financially if I pass away before or during retirement when interest rates are high? That's the first part. Okay. And what options are available within the ExxonMobil pension plan, and what additional measures should I consider? That's a pretty long one.
I might have you read the second one again.
Okay.
So let me do the first one first. So I mean, it goes back to, like I said, kind of reviewing that cash flow analysis, finding out, what your situation is. God forbid, you've got something terminal, and you see that coming along. But ultimately, if and when you pass away, the goal is to obviously protect your family and your spouse. So on the pension plan, it depends upon the election you take. If you take the annuity, you can do a single life annuity, which is not going to leave anything for your spouse. You can do a period certain where you're protected for a certain period of time. Or most likely, if you want to make sure your spouse is protected, you're going to do a joint survivor annuity, whether you want to pay out he or she, 100%, 50%, 75%. There's different options there. Versus if you want to make sure beyond your spouse, you want your kids taken care of. That's where a lot of times some people look at that lump sum, because once you take the lump sum, now you've got more full control over it. Because worst case scenario would be you set up let's say a joint survivor annuity, and you think you guys are in good shape, and something happens in 5 or 6 years, a crash or something, who knows? Then Exxon's keeping the rest of what was not paid out. Your family's not getting anything. Whereas if you take a lump sum, obviously you haven't spent all that down, hopefully, then it's going to go to your beneficiaries. Or whether you take that lump sum by your own annuity that's got joint survivor plus survivor benefits beyond that. So there are some options there. If you pass away prior to leaving ExxonMobil, it's a little bit different. It's based upon the plan rules. If you have been there for less than 15 years, your surviving spouse would get an annuity. If you've been there for more than 15 years, what they do is they look at it, assuming that you essentially retire the day you pass away. And so your spouse will get a lump sum option in there as well. So it's going to be more favorable if that were the case. And I apologize. What was that second question again?
I think you answered it. It was basically just asking what the options are, what measures can be taken to protect their families in the event of a
yeah, so there's a lot of different measures to take, but obviously the first one is to give us a call, run that cash flow analysis, just have a good idea of where you stand, and share that with your spouse as well, so he or she knows what the big picture looks like. But ultimately, we can kind of go through those one-on-one, because everybody's a little bit different as far as what their planning strategies are. Got a lot of people that want to write their last check at their deathbed. Maybe it's 95, maybe it's age 100. But they want that to balance. There's those that want to make sure they leave a certain amount to their beneficiaries, not just their spouse, but to their kids. So planning is going to be different from person to person. And I think you said that was the last question. Is that right, Sam?
Yes, that was it. Thank you, Wesley.
Just a quick reminder. I know she said it before. We've worked extensively with ExxonMobil over the years, so we've got a deep understanding of the plans. We'll be happy to help you with any questions. But again, that does not mean we're endorsed by ExxonMobil nor employed by them. But should you have any questions, just reach out. Give us a call at 1-800-900-5867. Thank you and have a great day.
Thank you, everybody.